What's up, folks? Now, normally we talk about real estate, passive investing, and investing in real hard assets. But a lot of you guys have been asking me about what's been going on with this crypto market. And today I'm going to talk a little bit about what stuff has been going on underneath the rug, we should say. I guess maybe that's a bad joke for some of you guys who got the rug pulled from you. But there's a little bit of a crumbling of the fortress, the deck of cards falling down, whatever you want to call it, that is sort of going unnoticed, that the whole stock market's taking a crap on everybody, which I kind of told you guys so, but we're not going to get into that today. I'm going to be talking a little bit about crypto investing, altcoins, and what a lot of my investors are doing today to get a little bit of stable yields, which is called staking. If you don't know what this is, check out our website. We have a info page at SimplePassiveCashflow.com/crypto. But first, I'm going to be kind of going through the basics so we don't leave anybody behind, because some of you guys out there are straight up hard asset real estate investors and you don't really care about crypto. So we're going to try and catch you guys up first. But again, you want the hint, that's why I'm coming up at the end. I told you guys so. You shouldn't have been investing in this stuff. I personally don't. And look, I definitely am somebody who is bullish for crypto in the long term, but it doesn't follow my 3 rules in investing. First, technically it cash flows because we'll talk about the staking today, but it's not a hard asset. Now, some people will argue that it is sort of a currency, but at the end of the day, these NTFs, in my opinion, maybe you call me old or something, I am your rich uncle, but I don't feel like it's a real hard asset, and it's not a commodity at the end of the day. And the biggest thing here is taxes. Say you buy something and it goes up double, triple, well, you got to pay the taxes on that. Where with real estate, you get so much of this cool passive losses, depreciation, where a lot of times you can offset those passive gains completely with passive losses. But here we go, a little bit crypto 101. Okay, so I'm going to break it down like this. You guys probably know what this whole crypto, Ethereum, Bitcoins are a couple of good examples, but the way I'm going to break it down is there's kind of a few ways you can invest in crypto. The most dangerous of them of all are altcoins. Right? These are kind of like the Doge coin, the douche coin, which I kind of called it. The little cute little Shiba Inu type of dog that it's been kind of the really funny memes out there if you go on Reddit. But these coins, they're not really based on anything. And a lot of these coins are quite frankly shit coins. And in a way, they're kind of the modern day type of venture capital into a tech startup. Now, I'm not a tech guy. I don't even begin to know what it is. After all, I just invest in stuff that makes sense, such as people need a place to live and they pay $700 to $1,400 a month rent. And they tend to pay a little bit more when you clean it up a little bit, you add a little bit of finishes, new appliances, new paint job, new flooring. But, basically what it is little tech startups. And in my opinion, these types of people, when they start to raise capital for these altcoins, is definitely skirting SEC. And the SEC is, Securities and Exchange, and they really regulate what's going on in America with raising a capital. And what they don't want is a bunch of unsophisticated and people without any track records to going out and just raising capital willy-nilly and then, basically creating a Ponzi scheme. And what they try to do sometimes, and why a lot of times non-accredited investors can't get into bigger deals, is they try and bar less sophisticated investors to get into bigger deals. Now, you obviously out there might think that's a little messed up, but I'm a parent these days, and quite frankly, I wouldn't let my little child do the same things as a young adult. No different than a 13, 14-year-old with his little Robinhood account or treating crypto on his app. They just don't have that life experience to make good, sound investment decisions, especially when there's big dollars at stake. So altcoins, I don't do them, but that's just what it is. It's high risk, high return type of investing. I quite frankly don't really feel like it's a good risk-adjusted return. And if you want to geek out on a particular term that we talk about a lot in our investment circles, it's the Sharpe ratio. It's basically some kind of math formula that some guy realized, basically taking the potential amount of returns divided by the perceived risk or the actual risk, who knows. But obviously you want to be going into different investments that have a pretty good amount of upside based on how much risk there is involved. And hint there, real estate, especially stabilized real estate where it's cash flowing day one, probably the best Sharpe ratio I think you can get out there, or the best risk adjusted return. Now the second out of third ways you can invest in this kind of space is investing in sort of the blue chip type of stocks. In this case, Bitcoin and Ethereum. Now, one little thing that I've kind of picked up from a lot of people is if you're going to invest in these main two, maybe go pick a certain ratio between Bitcoin and Ethereum, as they're the trailblazers. And, they're probably not going to be going around anytime soon. And, knock on wood, of course, because again, it's not really a hard asset in my opinion, but definitely a lot better stability than your altcoins. Now, we could argue what's a better risk-adjusted return, right? I mean, who knows? The altcoins, you can make 100x, 1000x, or Bitcoin, Ethereum today, you could maybe only make 5x or 25x or 50x. Whatever you guys think, put it into the comment section below. Let's get a little bit of conversation going. But if you're possibly getting 10x, 30x, but the real question that sophisticated investors ask is, what's the probability of my money going down to zero? And this is a concept called asymmetric risk. And what a lot of sophisticated investors will do is purposely go into deals where there's a high upside, but with a very small portion of their whole portfolio or net worth. We're talking like 1 to 5% here, which is obviously clashing with a lot of unsophisticated investors with 10, 50, 100% of their net worth into this altcoin or Bitcoin type of stuff. Now, the third type of way you can sort of play this game of new cryptocurrencies is this thing called staking. So it is sort of a less upside, less growth, but perceivably less risk. So basically what you're doing is you're putting your Bitcoin, Ethereum, or these other stable coins up, and you're letting the platform kind of borrow it like a bank. Now, I'm probably bastardizing this whole definition for the most part, but basically you stake your coins, and there's kind of some kind of influx, and you get a pretty decent rate of return. And I've seen it anywhere from 5% to 20%. And if you go off of some of the less known type of platforms, you get off the BlockFis, the Coinbases, and you go to more of these DeFi platforms, which is kind of off the beaten path and a little bit more risky. One would assume you get a little bit more return, so maybe 10% to sometimes even 30%. But here's what I want you guys to understand out there is like, when you're getting returns of 10, 15, 30%, you got to really scratch your head. In the private money lending world, right? Like if somebody's flipping a house and I'm gonna let them borrow my money, I'm looking to probably get around a 5 to 10% return. Now, the reason why is because the people I'm giving my money to, they're going to be like A paper, AA, AAA paper, right? People who've been in business, and it's a very low amount of risk. Now, a common mistake that investors make that are new is they chase these returns. They're like, Lane sucks. He's only getting like 5 to 10%. Little do they know that I'm actually working with legit operators who have a lot of experience. But they're going to go to give their money to some unproven house flipper out there who just did like a new boot camp or whatever. Or worse, they're going to go to a marketing company who's going to kind of peddle off a loan from some random person out there who hasn't done jack, and they're going to give them 15%, but they're going to go give the investor 12 to 13%. And the investor will be like, oh, I'm making a killing. But little do they know that their paper, their loan, or how they're securitized is pretty risky because they're investing with a jabroni, basically. Somebody who hasn't really done much. And in a way, this is what I'm talking about with this crypto staking stuff. Just because you're getting 15, 20, 25% in the staking doesn't mean that's a good risk-adjusted return. Who knows? Maybe like the amount of risk you're taking is 10, 20 times the amount of you're just investing in a Bitcoin or Ethereum. I mean, I don't know if that's the case, but I'm just using those types of terms. And again, think back to the Sharpe ratio. Maybe go check out that Wikipedia page and kind of internalize the mumble jumble there. But there's some good fundamentals of investing if you kind of understand that type of stuff. But here's what's been happening, right? And I'm kind of read through my list here, and what I'm kind of seeing is, shit's gonna hit the fan here pretty soon. And on April 25th, Matt Levine interviewed Sam Brakeman-Field and caught a glimpse of the truth of what the crypto Ponzi schemes out there, what they were talking about. And it's kind of that whole that concept of the emperor has no clothes, right? A lot of these altcoins, they've kind of come up through all these types of internet chat rooms or Discord channels, if you guys are familiar with them. For those older people out in there, think of it like Slack channels, except you're not at work. So basically you have a lot of these internet influencers who make themselves think like they're hot shit, but really they don't know jack. Kind of like this channel, right? This rich uncle channel. What the heck do I know? Other than I own over 8,000 units and over $1.1 billion of assets. But anyway, anybody can be an internet celebrity these days. But on May 8th, stablecoin, which is kind of one of those known as the word says stable, it's broke its $1 peg and was only worth 35 cents, and then it kind of went down from there. Later on in the month, stable gains, an app promising 15% on that stablecoin shut down abruptly, right? It's like, what the heck is happening here? And going back to the whole concept of staking, when you stake your coin, you're going to make that yield as long as this house of cards doesn't fall down. It's kind of like if you put your money in the bank, and the bank's going to give you some crappy 0.5% or less than 0.1%, which is an investment strategy for some people, right? It's like you put your money with them, but you don't. But you put your money with them, and the bank goes under, which has happened in the past. But today there's FDIC insurance and insurance on credit unions where the government sort of insures this. But there's none of this insurance on these DeFi networks or a lot of these crypto platforms, which is the problem. And for the same reason why people like these types of unregulated types of markets, in my opinion, sometimes regulation is good. It protects the unsophisticated investors from investing in a Ponzi scheme with some magical YouTube influencer pumping a coin. And how does these pump and dumps happen, right? So the influencer goes out and they kind of stockpile a bunch of investors, unsophisticated investors, each putting in anywhere from $5 their life savings of $10,000. I'm joking there, but I'm really not, right? A lot of that's the kind of people they're getting this money from. The masses, the huge masses out there are putting in money into this stuff in hopes of getting huge astronomical returns. But there's usually a little lockup period. So in the institutional investment world, this is kind of called, you load into a fund, but there's sort of a lockout period where you can't just pull it out. Or kind of like when you guys work, go to work and you invest in a 401k, company sponsored plan. They tell you you're vested until a certain point. You can't really have it until you stay a certain years at the company. Well, same concept and idea here. They're like, well, buy this, random yellow and green polka dot crypto coin, and you're buying it at a good price, of course, right? They're trying to market it all up, and there's kind of this huge internet frenzy and these Discord and Twitter-like forums, and they're pumping this coin up, but you can only sell after a certain amount of period. And then, so the whole point is the sponsors, people who are in charge, and that next run of investors, they go in, and then they're kind of recycled with the masses that kind of come in there. They see the massive growth on this app, but until you cash out on that asset and take it to some other real currency, and I would say, US dollars is one, or taking US dollars and putting it into real estate, it's not a real thing. It's just numbers on an app. But sort of intentionally in a lot of these types of cryptocurrencies is, this concept of the rug pull, right? They just load enough people in, and then when they get to critical mass, and when the first people hit that lockout period, that's when they pull the rug out on everybody, and the valuation tanks. But the first people made it big because they were able to sell at the right time for the masses. Now, I don't know if that's exactly how it works in every single situation, but we're starting to see the cracks crumble. We're starting to see the cracks in the armory here, not just in the individual coins, but kind of the whole system. And I call this the counterparty risk, right? Like it's kind of like your bank falling down on you that you put your money in. Getting back on the timeline, in June, Celsius, which I would argue is probably one of the top 5 platforms for this staking, and for mainstream crypto investing, they froze all their investors' assets, and they severely slowed down all the withdrawals. So I had a lot of my investors kind of scrambling, taking money out of this stuff, and a lot of them chose to put money back into their own cold storage, which is basically they have it on kind of their USB drive and not on the platform, because that's again where the issue is happening, is on these platforms. The platforms are collapsing, kind of like how a bank would, but these platforms are not brick and mortar, but they're out there in the internet space. But so Celsius froze all their assets because they didn't want this run on the bank or run on themselves to happen. Later on in June, Babel Finance, which refers to themselves as the world's leading comprehensive crypto financial service provider, they limited withdrawals to $1,500 per person, to $1,500 per month. Later on, Voyager Digital, and this is at this point it's kind of happening all at the same time. They set a $10,000 daily withdrawal limit. Now, a lot of those headlines were kind of out and center, but some of these other headlines that I'm kind of going through now are coming through like Twitter, like influencers who are legit. They had a previous experience building up other tech companies. They are legit influencers in the space, and they're kind of sounding up in some of the issues that are happening. This guy, Batman Terra, says, "This is incredible. A centralized yield service, CoinFlex, gave a $47 million uncollateralized loan to someone who can't pay it right now to fund other customers' withdrawals. They are now turning this debt into a token and selling it to people, offering 20% APY on it. Amazingly." And another one here, and this one on crypto-news-flash.com. Celsius, we talked about them, one of the bigger platforms, CEO Alex Mashinsky accused of trying to run and missed company bankruptcy. He's trying to fly to Israel. I would probably want to go to Hawaii or Mexico, but I don't know, maybe Israel's where he's from. But you see a lot of these high-level folks kind of get out of town, and quietly I think you're seeing a lot of the altcoin influencers. That what I'm talking about are the people who don't really have any experience in the tech world. They're just influencers. They're kind of modern day digital marketers. This time they're not selling essential oils or CBD stuff, but they're selling crypto coins or altcoins in this case. But anyway, look, some of the stuff might have been wrong. If it was, please correct me in the comments below. But here's my whole point with this, is like this stuff that people are doing, I could have told you, like, stop chasing yields. Instead, invest off of Sharpe ratio or risk-adjusted returns. Like, what is it up that you can get the best returns but for the least amount of risk? Right? It may not be the place that you get 20, 30, 40% returns every year, because quite frankly, it's not real. And that's what I'm coming back to. Like, invest in stuff that's real. And wealth comes to those people who create value in the world. Not buy low, sell high traders, or people who invest in certain stocks, or even do options trading, or especially like this crypto stuff. Now, if you're the person making the coin and stuff like that, now that's different. You're adding value into the system. But really, how many of you guys can do that out there? Whereas if you buy real estate and you change out the carpets, you change out the appliances, you kind of, in our case, in the apartments, we improve the communities, make it better living conditions. Now, that's something people pay more money for, and we're creating value there. And that's really the sustainable way to create wealth, which I think, if there is a recession coming, which I think there is, but it's a soft landing recession, like I think we've been on a tear lately with GDP growth. We could, a 0.5%, 1.5% negative GDP growth for a couple quarters in a row isn't going to be the end of the world, especially with inflation keep going up. I mean, that's just going to mean that you have to put your money to work. And I just think where we're at, like, it just makes more sense to put your money in stable stuff such as real estate, especially if it's stabilizing cash flowing currently today, and then you can weather that storm. But that's the whole thing today. We didn't really talk about taxes. Don't get me started on that. But maybe we can talk about that in a future video. But just want to update you guys on what's happening with the crypto world. And I want to leave you with one last kind of tip, which is, I'm just speaking from experience. I took my money out of that BlockFi stuff. I was wanting to learn about it, and sometimes the best way to learn is actually do it. But I was just kind of like, screw this. Like, my highest and best use of my time is investing in real estate, doing my deals. And I implore you guys to kind of think the same way. For you guys, we're all here trying to change time for money. For some of you guys, it might just be at your day jobs out there, or buying rental real estate. Or maybe you have enough money and it's just a matter of, getting a good yield at that point and being a professional investor. And basically that's what you do, right? You just invest your money and live off the cash flow. But, I think that's what we have to always think is like, what is our highest and best use, and to do something when you have a competitive advantage with. And I just don't think that, investing in stocks, the 401k or crypto altcoin, I just don't think any of us ever can have an unfair advantage doing any of that type of stuff. And at the end of the day, it doesn't really create value in the world. But that's it. Obviously today, from my talk today, you probably think I'm an old person, but I don't care, because I'll drive a Ferrari eventually, and I don't care at that point. But whatever, who knows if I'll buy that anyway. But thanks guys, and we'll see you guys next time.